Your phone is buzzing. The alerts won't stop. Tensions are escalating. Markets are volatile. Everyone's talking about World War III. And the first thing you did wasn't call your family. You opened your brokerage app, not to check if you're okay, to check if your portfolio is okay. That's what financial anxiety does. It hijacks every survival instinct and redirects it toward a number on a screen. And here's where it gets dangerous. While you're staring at that red number, someone else is doing something that looks completely insane. They're buying, not randomly, not emotionally, in a very specific order based on what actually happens to money during every major conflict in history. By the end of this video, the gap between what you did and what they did is going to make you genuinely uncomfortable, not with them, with the system that convinced you panic was smart. Your panic is literally their product. Every time geopolitical tension spikes, viewership goes up, ad revenue goes up, engagement goes up. The more scared you are, the longer you watch. The longer you watch, the more money they make. So when markets drop 2% on a war headline and the banner screams, "Global markets in freefall," understand what's actually happening. A 2% drop is a Tuesday. It's been called freefall because freefall makes you click. Moderate pullback, consistent with historical patterns, doesn't get the same ratings. Never has. Never will. The entire ecosystem, the news segment, the expert they interview, the brokerage platform running ads every commercial break, profits from you doing the exact wrong thing at the exact right moment for them. And you pay for it. With fees, with taxes, on panic sales, with misrecovery. Let me tell you about two people. Call them David and Priya. Same $40,000 portfolio. Same morning, February 24th, 2022. Same news alerts about Russia invading Ukraine. David watched the coverage for 3 hours straight. Sold everything by 9 a.m. Felt relief, felt smart. Priya read one data point, that the S&P 500 had delivered positive one-year returns after 73% of all armed conflicts since World War II. She turned off the TV and went to work. Here's what happened next. The S&P fell 2.5% that morning, then closed the day up 1.5%. The market had already priced in the uncertainty the moment the invasion actually began. The range of possible outcomes narrowed and capital started moving rationally again. David missed the intraday recovery. He sat in cash for 4 months, paid capital gains tax on the sale, re-entered after the snapback. 4 years later, his $40,000 is worth $48,000. Priya did almost nothing. She left her automatic contributions running, made 3 specific additions to her portfolio. Today, that same $40,000 plus her contributions and tactical positions is worth $91,000. Same starting point, same news, a $43,000 difference. This is where mass psychology reveals itself. Not in theory, in dollars. That wave of relief David felt when he hit sell, that wasn't clarity. Psychologists call it compensatory control. When the world feels uncertain, your brain craves action, not smart action, just action, because action feels like power, even when it's destroying your future. Here's the data that financial media will never lead with, because it would immediately reduce your anxiety, and they cannot afford for you to be less anxious. Markets don't die in wars, they dip and then they climb. The Dow gained 50% during World War II, 60% during the Korean War. According to LPL research, after a geopolitical shock, markets bottom in about 3 weeks and recover within 1 to 2 months. JP Morgan tracked the cost of panic precisely. $10,000 invested in the S&P 500 from 2005 through 2024 grew to $71,000 if left untouched. Miss the 10 best trading days in that stretch and you end with $32,000. Here's the part that will stop you cold. 7 of the 10 best days happen within 2 weeks of the 10 worst. The crash and the recovery are the same event. When you sell for relief, you guarantee you miss both. So what did Priya actually buy? First, a cash floor, nothing more. 6 to 12 months of expenses in a high-yield savings account, plus $2,000, $5,000 in physical cash at home. Not as a prepper move, but as a hedge against a 3-day banking disruption. When Russia was cut from SWIFT in 2022, ordinary citizens woke up to frozen ATMs. Cyber warfare doesn't target your money. It targets the pipes that move it. Build a floor, then stop. Every dollar beyond that sitting in cash during wartime is quietly evaporating. Wars are inflationary by design. Governments borrow massively and inflate their obligations away. Second, gold. But not for the reason you think. Most people's instinct is buy gold now because the world is ending. That instinct is right about the asset and catastrophically wrong about the timing. People who bought gold at the 1980 peak during the Soviet invasion of Afghanistan waited 26 years to break even in inflation-adjusted terms. Gold spikes on fear, then gives the premium back once the worst case doesn't fully materialize. Gold is best bought before the crisis hits the front page. Right now, central banks are buying over 1,000 tons annually, the highest levels on record. That's not panic buying. That's institutional repositioning. When that's happening, the move isn't over 10-15% allocation. Keep a small slice in physical for short-term disruptions. Third, the uncomfortable trade defense and energy. Profiting from conflict doesn't sit well with most people's self-image. That's the moral anchoring glitch at work. But the discomfort doesn't change the numbers. Raytheon gained 37% in the single week, after 9/11. A $10,000 split across the top 5 defense contractors in September 2001 was worth $97,000 by 2021. In 2022, while the S&P lost 18%, defense outperformed by 28 percentage points. These aren't short-term war trades, they're decade-long structural shifts that conflict only accelerates. ETF. ZAR. For energy, conflict restricts supply, panic drives premiums, and in 2022, XLE gained 64% while the broad market fell. That's an 8-2-point gap, the largest in the ETF's history. Fourth, consumer staples and inflation protection. People don't stop buying Tide during war. They cancel vacations. They don't cancel Tylenol and paper towels. When the S&P was down 17% through August 2022, XLP lost only 4%. Nobody is impressed by it, but it keeps you warm. Pair that with TIPS Treasury inflation-protected securities, which automatically adjust your principal as inflation rises. Standard long-term bonds get crushed in wartime. TIPS don't. And finally, your index funds. Untouchable. VOO, VTI, SPY. Do not touch them. Large cap stocks returned 11.4% annually during wartime periods higher than the peacetime average. The war economy is a stimulus economy. If you have a Roth IRA, a downturn is the single best time to contribute. You're buying tax-free growth at a discount. Back to that morning. Your phone is exploding. The headlines are red. Some analyst with perfect hair is explaining why this time is different. The person without a plan opens the app, sells everything, feels briefly smart, and spends the next year watching from the sidelines while the channel that scared them runs brokerage ads every commercial break. The person with a plan checks the structure. Cash floor, gold, defense, energy, staples, untouched index funds, puts the phone down, makes coffee. David is still watching the channel that cost him $43,000. Priya stopped watching it the morning she turned off the TV. The matrix of mass panic only has power over you if you don't have a framework built before the headline hits. The time to build it isn't when missiles are flying. It's now.